name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. A second bullish white soldier yesterday, and in an attempt to break up and outwards from this recent confinement that the market is within. Prices moved up over the upper trend line, currently 117.96 of the descending wedge pattern. However, the top was surprisingly caught by the paralleling short moving average, currently 118.12, and prices dropped back to close just under the trend line. Further above, we have the June high at 118.51, whilst below we have the powerful and significant 50% Fibonacci line of the June 2020 to January 2021 move at 117.58, with the lower trend line currently at 117.08 below that, and further congestion slightly below, made up of the paralleling middle time, currently 116.94 of the January to May bearish pitchfork, the neckline of the August to September 2020 head and shoulders neckline, currently 116.98, and the lesser Fibonacci level at 116.90. That's actually quite a lot below at the moment, though by no means insurmountable. A quick word now about this descending wedge pattern that we're within, as it may be coming to a cusp. Now, wedge patterns can break in either direction, but they have something like a 70% chance of breaking higher, so please bear that in mind. I can't give any targets as yet, but I can give an idea of the size of the move when it happens. An upwards break would be about 135 ticks on top of the broken downtrend, whilst a downward break would be about 65 ticks off the broken lower trend line. The descending wedge terminates in early September. I imagine we'll have a break before then. Now, one final point, beware of false breaks with this wedge and wedges generally. They are really quite common, so please treat all attempted moves with caution. So far today, a higher open just over the upper trend line, but then a pull back down all the way, almost, to the key 50% Fibonacci level at 117.58. Right now we're actually looking as if we might be moving towards a bearish harami, maybe even a possible, if we do extend, a possible bearish engulfing pattern. I actually don't think we'll have a bearish harami, but we may have a bearish dark cloud cover pattern. We'll see where we close tonight. Cable, aka sterling against the US dollar. A reactionary bullish white soldier yesterday after Friday's not quite bearish dark cloud cover pattern. The market broke up and out of the bracket we'd seen late last week of in between the declining short moving average, currently 137.89 top side, and the gently rising long moving average, currently 137.27, that's below. Now, the move up was strong enough to pierce the important June to date downtrend, currently at 138.07, but failed to close over it, managing actually just to close on it instead. I still have the idea I put forward last month of a very large Adam and Eve type double top formed over the whole of this year. However, this option is halted for the moment, as we'd need consecutive closes below the interesting 61.8% Fibonacci line, the whole of the 2016 action at 136.54 to make it happen. Now, this Fibonacci level is acting as an ad hoc neckline in practice. Finally, as a counter to this bearishness, I would remind you all about my words from last week on how this was the first challenge to the long moving average since September 2020. Please note that challenge back in September last year was unsuccessful. So far today, a slightly higher open over the breached but unbroken downtrend, but prices have since declined back below both the downtrend and the short moving average, and makes today look like a possible, I don't know, bearish harami possibly at the moment. Euro sterling, a bearish engulfing pattern yesterday, if only just. This comes after a 2-day bearish inverted hammer pattern. Overall, the market is back within the May today based bear channel, currently 84.76 to 85.64. Overhead, we still have the strong resistance from the medium moving average, currently 86.01, and the short medium moving average, currently 85.85. Meanwhile, below, under the lower bear channel, we have the support at 84.69. Now, this support was originally halted the decline back in April. Now, we are actually in the last week of July, as you all know, and we are already on set possible monthly key reversal. We close this coming Friday either over 8600 or 8570, then we'd be on. Anything in between and we'd have a lesser outside month. So close of business to Friday, well, close of business yesterday, Monday, we were looking at a monthly key reversal down, if only just. Now, so far today, small reactionary rise after yesterday's small move down and the earlier 2-day bearish inverted hammer pattern. However, it is not that much, and we are currently looking like an indecisive doji cross. US dollar against the Indian rupee. A bearish closing black Mariposa yesterday. This all comes after the 2 previous sessions were indecisive spinning tops, one of which was also a bearish engulfing pattern. On a bigger scale, last week the market made a weekly key reversal down and had also punched out and below the recent ascending broadening wedge pattern formed over June and July. I should warn you that there is still the chance of this being a false break lower or even a pullback up, followed by a renewed attempt lower. However, I still feel it appropriate to give an idea of the possible targets on the downside. Initial target X will be in the 74.05 area, whilst the further secondary target X1 will be in the 73.80 area. On its way down, the market would have to negotiate the 50% Fibonacci line of the February to April 2020 move at 74.26, as well as some late June congestion between 74.10 and 74.20. However, and it is a big however, wedge patterns are very prone to false breaks, and as I've already mentioned, they have pullback issues in that they may drop down, pull back up quite a bit, giving the impression of a false break, and then drop down for real at a later time. Hence, great caution how you react, as all may not be as it seems at first glance. So far today, a significant gapping open lower, just above the 50% Fibonacci line at 74.26, but then moved back up all the way to the broken trend line of the ascending broadening wedge pattern before a small pullback. This has left today with potentially very interesting patterns. We could have today as all or some of the following: a key reversal up, bullish engulfing pattern, a bullish opening white Mariposa. It all now depends on where we will close tonight. US dollar against the Brazilian real. Bearish engulfing pattern yesterday, coming as it did after the previous week's worth of testing the overhead breached, but still potent descending upper time, currently 519.14, with the late May to early July bearish Andrews pitchfork. I'd been wondering all of last week if this pitchfork would last a week. Well, it just about managed to do so, but at no major credit to itself. Meanwhile, below we still have the flatlining short medium moving average, currently at 513.79, which halted the fall yesterday, and also the rising short moving average, currently with 517.43, which did a good job of just interfering. Normally I would not mention the short moving average, but it played an invaluable role in halting and turning the market back up 2 weeks ago, so it's worth a mention. Overall, we still have the argument I outlined 2 weeks ago for the late June to date action being a bull flag, well, maybe a bull, I don't know, halfway hesitation possibly. But for me, it's getting thinner and thinner each day. You see, you could as easily argue the July action as a double top, which I think is beginning to make more sense. But it all needs time. This is all in the shadow of the remarkable number of dead crosses we've seen here since late May. It all now depends on whether the bearish Andrews pitchfork will finally reassert its hold. Higher up on the top side we have the declining medium moving average, currently 531.92, and the long moving average, currently 535.17, both now entering the frame. US dollar against the Mexican peso. A fourth bearish black crow yesterday, but it was also an indecisive spinning top. However, there is so much more to that action. For starters, it was a really long-legged one on the top side, stretching up through the overhead resistance of the declining medium moving average, currently 20.0921, and holding just short of the declining long moving average, currently 20.1730. Meanwhile, its action below almost made it into a key reversal. However, the flatlining short medium moving average, currently 19.9710, along with the short moving average, currently 19.9765, managed to halt the decline, just like Friday. Overall, nothing has taken us away from the extensive indecision we've seen previously in this market. Indecision that stretches from the fall back to these levels originally seen in mid-April, but which recently started again in late June. Now, the adherence of the market to the gently declining neckline of the February to March head and shoulders top, currently 1985.90, is still indicative of this neckline acting as an attractor for the market. Further below we have the April to May based congestion zone between 1985 and 1995, with the neckline lower support currently at 1959.95 of the late June to mid-May head and shoulders top, acting as further support. Now so far today, a reactionary move up just over the medium moving average, but once again halting short of the long moving average overhead. It continues to look like these two declining moving averages are exerting a continuing bearish pressure on the market. Thank you for listening. This short version broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.